Welcome to the 3 Edge Week in Review for the week of March 24th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and my colleague, Dr. Bob Phillips, is joining me here today. Bob is Managing Partner, Chief Technology Officer, and member of the Investment Committee here at 3 Edge Asset Management. As you can probably tell from my background, I'm traveling this week, visiting many of the advisors who utilize our investment strategies on behalf of their clients. And today, Bob and I are going to discuss the ever-expanding world of private credit, which, to be honest, most folks are simply not aware of. Yet, it has grown to be a large and highly leveraged market where an accident could pose major systemic risk to the global capital markets. So, without further ado, let me bring Bob in. Bob, welcome back to the Week in Review.
Good to be here again, Fritz.
So why don't we begin by just having you explain, what exactly are private credit markets? What are they used for? And I guess who are the players in this market?
Sure. Thanks, Fritz. Private credit's been around for a long time, of course. It's really lending outside of the traditional banking model. And when it really accelerated after the Great Recession in 08, 09, because the new capital requirements that were put in place for banks really, and reserve requirements, made it more difficult for them to lend to companies, particularly that were a little bit risky.
Right.
In the past, they would have just raised the rates and lended to them. Now it's harder, and there's also less capital available for that kind of lending. And so the private equity and hedge funds really stepped into that void and started to provide credit for companies that traditionally would have gone to the banks. And what's interesting about that market is it was relatively small for quite a long time, but by 2020 it had grown to about $1 trillion, and more recently it's estimated to be around 1.5 trillion, which, just for comparison, the high yield market in the US is about 1.4 trillion. So it's on the same order of magnitude as the call it more traditional high yield market, which is obviously the public market version of lending to more risky companies. What's really interesting, the growth rate is so fast that it's projected to double again by 2029. Now, will that happen? Of course, it will depend on how the markets behave over that time period, but that's really rapid growth. One of the things that has helped drive that growth, though, is in fact the securitization of some of these loans. The hedge funds and private equity firms often don't end up just carrying these on their books, but they break them up into pieces, tranches, if you will. Some of you from the days of 2008 and 2007 may remember that term. And securitize it and sell it out, because the types of buyers are often institutions, but also insurance companies, people looking for higher yields, which these provide. There's at least the perception of some degree of liquidity behind these securitized vehicles. Now, it'll be interesting to see if that is sustainable as we get into this period of market volatility, but that's really what we have today. And it's been a big benefit for lots of companies that couldn't get credit any other way.
Right, absolutely. So exactly as you said, though, when I think about this, I think about the rapid growth in this market. I mean, I can't help but be reminded of what happened to AIG during the financial crisis, where this major insurance company was brought to its knees by a small group within AIG known as the Financial Products Division. That was, making really large bets on risky mortgage-backed securities. But so are we seeing the potential for the same types of risk and accident now with private credit? And I guess my question is, what are some of the potential risks? And then in particular, why might the current environment pose increased risk for private credit?
Well, I think, the kinds of risks that we're talking about, in fact, are somewhat similar to the risks that were involved with what was then mortgage-backed securities that eventually had a fairly significant exposure to the subprime lending market, which was a high-risk market. And the demand for those products made it such that more and more of the more risky components were mixed in with the less risky components in the securitization process. And that's what ultimately struggled and had issues that kicked off that crisis. a lot of the same issues, so a lot of the same challenges, lack of transparency. I mean, these aren't banks. These are hedge funds and private equity firms that don't necessarily provide much transparency around these vehicles. They don't have to mark to market. The leverage involved, again, not a lot of transparency around that leverage. It's hard to gauge exactly what the level of leverage is by these companies. Hedge funds and private equity, many of them are very good at managing in high leverage environments, but it does impose a certain degree of risk. The illiquidity, they're just less liquid. They're not traded on the public markets. The pricing is uncertain. There's not as much regulation. In fact, very little regulation regarding fraud and misconduct. You're relying on the underwriting standards of hedge funds and private equity firms to really do this. Again, not that they're incapable of doing it, and they certainly aren't interested in putting their own investors at risk who are putting up much of the funds. But that's it. And then systemic risk, which is very hard to gauge. People for a long time have been saying that the systemic risks associated with this type of lending was nothing like what occurred in the mortgage-backed security times. But it's just not known because at the end of the day, the private equity and hedge fund folks are relying on banks for their leverage in many cases, and these are securitized instruments, and so and so it's interesting. It's an interesting area that as things heat up in the markets and some of these companies become challenged, we've seen even more announcements around tariffs this week, more coming next week, how that will impact companies' ability to derive profits and cash flow, because they're really paying these loans is dependent on the cash flow in many of these companies. And some of them have pretty high levels of debt, and it's in this private market. How much of that is endangered or where the risk is, hard to gauge right now.
Right. Absolutely. So as always in these videos, my final question is, now that we've talked about the potential risk for private credit, what can investors do to protect themselves from, it's really somewhat obscure risk? And so I think my question would be, is this type of systemic risk or potential risk from private credit, would this be more of what might be a black swan event? And if that's the case, I think it would be helpful if you could just explain, well, how do we here at 300, how does one hedge that eventuality for something that, really might come out of left field?
So we definitely think about this as I know you and Steve have talked about many times. We spend a lot of time talking about and thinking about what might be a black swan in the market, essentially a low probability but high impact event that can occur. And as we've often said, they occur with greater frequency than most traditional efficient market theories would predict. This is certainly one of the things in that category. And I think what we look at a few measures that might be considered canaries or early warning signals about this. For example, as has been interesting, there have been a few ETFs created around this private credit market, and watching the short positions in those private in those ETFs, and the ETFs themselves may react faster than the market because again, we often look for market-based signals. That's really what we're after for this. It also is embedded to a certain extent in the spread between high yield bonds and corporate bonds, high yield being a surrogate for this kind of credit, but probably an amplified surrogate. So in other words, if you look at the spread between high yield bonds and corporate credit, you can probably multiply that by a factor to get something like what the private credit might be, because it's inherently somewhat riskier credit that's on the line there. And those are the kinds of things that we typically look at and are likely to give us that canary signal that we're often keeping a close eye on if it becomes important. early enough to impact our models and start to move us away from the danger zone. Because as I said earlier, things like people like insurance companies and other areas, other folks have invested in these things. If they prove to be illiquid in times of stress, that will put stress directly on the overall market, just as played out in the period of the Great Recession. Again, it's unknown about whether this is could be of the magnitude of what happened in 07 and 08, but it's something we certainly keep an eye on as part of our overall investment analysis and strategy. And we have tools built into the model to really watch for this carefully.
Excellent. Bob, thank you very much. I do feel it's important to at least let our listeners and our clients know, this potential risk as I said, is an obscure region of the markets, and that we have our eyes on it in order to keep our clients safe. And hopefully this will be the last we have to talk about it.
Let's hope. Let's hope it never comes up. Let's hope the canary never sings. Let's hope that.
Yeah, exactly right. So, but no, I think it's good to bring it up and to show that, we're basically in the position to be able to take steps even for obscure risk, because we have those canaries in the model that will help us keep in front of this information. So thank you very much. Always great to have you join us. Very good.
Thank you.
So that will do it for Bob and me for this week. As a reminder, our videos are always available on our 3Edge YouTube channel. If you know someone who might benefit from them, please feel free to share them. And if you do enjoy these videos, please consider subscribing to our 3Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Bob and everyone here at 3Edge, thanks for listening.